Good afternoon, everyone, and welcome to Park Edge Market Insights for December 10th, 2025. I'm Matt Gordillo, partner and financial advisor with Park Edge. I'm joined by Gavin Gowecki, our portfolio manager, and Rich Lowry, partner and chief investment officer. First, a moment from our sponsors. Very good. Thank you, Gavin and Rich. Welcome. Happy holidays to you.
Thanks, Matt.
Hey, Matt.
I figured I would come to the final market insights of the year with Santa flying a sleigh over palm trees.
I like that. I was going to ask you what that shirt was a few minutes ago, so I'm glad you clarified. But I'm sporting Park Edge gear. But Gavin, as we do every month, why don't you start us off with what happened from last month?
Sure. Last month, around this time, we were talking about the possibility of a potential kind of risk off that could be short term in nature. What we ended up getting at the middle of November into the end of the month was indeed a bit of a risk off. And although markets have generally kind of retraced that risk off, that move, as Rich will kind of talk about, there's still kind of a lingering, kind of short-term wait and see what's actually happening here. Maybe around, the Fed decision today and the timeline on that. But anyway, that's kind of where we are from last time. That ended up playing out, and here we are in December.
Hey, Rich, every morning when I open my email, I feel like it's the clickbait of the season is market outlooks for 2026. And
Yeah.
I think even I might have received some from family members that are sending me market outlooks. And so I thought I'd give you this opportunity to share your thoughts and what Park Edge's thoughts are about market outlooks and where do we go from here? How do we approach it?
Yeah, well, my inbox is clogged with them too. Not a day goes by where I get, a batch of them. I just don't see any value in them. There's so many things that are going to happen between now and the end of the year. Not only do you have to get the size and the scope right, but the sequence matters. So it's almost an impossible task, but like you said, it's good clickbait, right? People say, oh, hey, look at what so-and-so is saying, which is why we built our process basically around reading and reacting. What are we seeing right in front of us today? Is that indicating that global markets, global macro is pricing in a risk-on environment where you get paid to take risk? Or are we starting to see pricing in a risk-off? If we start to see pricing in risk-off, we could take risk down. And when the same signals indicate that threat is behind us, when that storm has passed or weakened, then we can go to putting, risk back on. So, ours is kind of dialed in, between now and the next month. And then we have other signals that will say between 1 and 3 months. So, take last month, the day we published Market Insights, the forward conditions, the 1 to 3 month conditions went negative. That is our heads up to be on the lookout for a phase transition to risk off. As the month unfolded, our signals did confirm deterioration in the equity market, pickup in volatility, some change in the currency market around the dollar getting strong. That looked like a gathering storm, but it dissipated. So, I would treat that as a false positive. Signal said, take risk down, but a storm didn't hit. That is a much more tolerable error than a false negative. A false negative would say, no, our signals are not picking up risk off, and then you get hammered by, a market crash. So I think that would be the main difference in our approach is ours is more dialed into being in alignment with the market. So if we're focused on being in alignment with it, I could care less about what somebody says is going to happen back half of next year. That would be like a football coach coming into a game saying, I have every play we're going to run all games scripted out. And I'm just going to call those plays in sequence that I have written on my notebook without regard to any in-game, condition. So
Maybe our head coach of our Cleveland Browns might want to take that playbook and just call out all his plays for the whole year, because boy, the play calling at the end of the last game is a real head scratcher. So I'm glad we don't subscribe to that methodology. So
I think the big thing going in, not, this isn't, a forecast. But the big thing I think that investors should be mindful of as we go into next year is that the Fed is behind the curve. And are they going to get caught up? That's kind of number one. Number two is we have this K-shaped economy. K-shaped meaning if you line up a graph, well, first of all, K-shape is that the top 10, let's say, are doing good. Asset markets go up, real estate goes up. They own both of those. They do well. They're net savers. So when interest rates go up, they earn more in their savings. Things are good for the top 10. It's the bottom 60 to 70 million households that are struggling. And the way the CPI calculates it is highly flawed. Our friend Mike Green over at Simplify Asset Management put out a very thought-provoking piece a couple of weeks ago that has since gone viral. And, for example, most families have two income earners. And if you have a second income earner, then automatically you need daycare. And daycare is rising much faster than the overall CPI. You need a second car. And they do what are called quality adjustments or hedonic adjustments that say, yeah, the price of the car went from here to here, but you got all this extra quality, you got all this technology, all these airbags. So in the CPI, it looks like a modest increase because they're trying to factor in quality. That may be great for a statistician, but the bottom line is the family's car payment just went up a lot because they're forced to buy all that, added technology. And he made the point that, basically everybody 100,000 and under is struggling. And if you line up a chart of the S&P 500, and let's say that's a proxy for the top, it would be the largest companies out there with access to the capital markets, so they don't have to borrow from banks. They have net cash relative to their debt, so when interest rates are high, they're earning a lot of money on their, T-bill holdings. That's pointed this way. And if you look at University of Michigan consumer expectations for current conditions, it's the lowest reading ever, lower than the 2008 financial crisis. Same with NFIB small business sentiment of current conditions is like that. So the two together is S&P, a proxy for the top, is doing this, and sentiment around current conditions for households and small businesses doing that. That's the K-shape. To us, that's the most destabilizing force out there, because if you don't fix it, you're going to have trouble. That's classic fourth turning. We've talked about the fourth turning before. We had that piece that we sent out to all clients on the fourth turning. That's kind of a hallmark of fourth turning, is that inequality gets stretched so far it breaks and then it reverts back. And just a caveat, there's always going to be inequality as long as there's inequality of work ethic, habits, skill,
sure,
ambition, creativity, all that. But it's when the government has policies that exacerbate that, where it becomes untenable. And this started with QE, where the Fed prints bank reserves out of thin air to buy bonds. And by removing duration, it forces people into stocks. Almost a direct quote of Ben Bernanke when he floated that at Jackson Hole in 2007 is that rising stock prices are going to make people feel rich. Therefore, they're going to go out and spend more. And that is going to be the magic formula. Well, all it did is blow an asset bubble to help the top. The younger generation that doesn't own the same amount of assets has been struggling. Real estate, home ownership is out of their reach. And along the way, and I think this goes back to around 2000, the Fed has treated wage growth as a sign of inflation. So when the economy gets too strong, they wait for wage growth to start going up. And they think, wrongly, they think that rising wages means employers are going to have to raise prices, which is going to cause a cycle of inflation. And they've tightened. Every time you've had strong wage growth, they've tightened to dampen that down. So you can't have a Fed who, and it could be, I'm not saying this is intentional. It could just be when you get super, super smart people and they buy into the wrong framework. You know, us peasants can't tell them that they're wrong. You know, but Fed policy has inflated the top. Fed policy has, you know, dampened income growth for the bottom. It's classic fourth turning and it can't last. So what is the way out? And I think, what was it, the September issue of Market Insights, Gavin, where we said the only way out is the Fed is going to have to print. Otherwise, the Treasury has to come to market to borrow all this money to finance deficits. They're going to crowd out private investment. When the Treasury crowds out private investment, it's not going to hurt Google and Apple. It's going to hurt small businesses and households. So to prevent that, the Fed is going to have to print. So what we're seeing now, if you look at kind of the kind of connect the dots, the administration is arguing for the Fed to bring rates down. We agree. We think the Fed funds rate, if it were neutral today, would be 100 basis points below where it is currently. They cut by 25 just minutes ago, but they have to catch up. They're going to get rates down. The Fed announced another acronym where they print bank reserves to buy securities. That's going to be geared toward treasuries. So now they've created a new buyer of treasuries. So when the next quarterly refunding announcement comes out, we're probably going to see a continued shift toward more bill issuance. And if the Treasury is going to issue a ton of bills and the Fed's going to be the one to buy it, that is monetizing the debt, but at least it's not crowding out the bottom part of the K, you know, which has been a chronic, you know, problem for, you know, several years now. So the forward conditions that we still see as unfavorable are 1 to 3 months out. And, you know, if we had to put kind of a label on that, like what is that system picking up that we're not seeing in other signals, is that the Fed's too late. You know, so it looks at growth, inflation, monetary policy, fiscal policy, positioning, liquidity, and where we're seeing the strongest negative impulse is on monetary policy. So if the Fed catches up, and if they use that new facility, you know, to monetize some of the Treasury issuance, we could see that flip back to positive. And our outlook for next year is going to be a flip from negative fiscal impulse to positive. Tax cuts are going to kick in, deregulation are going to kick in. We've had this slowdown already that we're calling a U-shape, where we slowed down. We've kind of been searching for a bottom, and it looks like that is about to inflect. Again, if the Fed stays behind the curve, it may not give that U a chance to inflect. But if they get caught up, we see that inflecting. So positive for, you know, at least first 3 to 6 months of the year. We don't have visibility beyond that, but I wouldn't be surprised if it lasted longer. It's just getting between here and there, the next, you know, 1 to 2 months, that could be somewhat of a challenge.
Well, I think clients understand that it can become bumpy and in the short term. And that's one thing I would probably reiterate is, like, even our very short term, you know, discussions or opinions can change between now and even our next market insights. And, you know, to me, what I hear, inequality in the marketplace equals opportunity. And, you know, Rich, I see you as a Fed guru, and really it's comforting to know that, you know, you understand the ins and outs of the Fed so well and the impacts that it can have. I think that's reassuring for our clients. And then coupled, Gavin, with your portfolio management, you know, I'm sure you're taking copious notes and I know you meet with Rich regularly to help direct investment decisions of when to take risk and when to maybe reduce risk. So I think as clients start to spend time with their families here at the year end, hopefully you guys do as well. It's good to know that the team at Park Edge is hard at work and looking out for their best interest and getting them ready for whatever comes about in the next 1, 3, 6 months going forward. And we'll do our best to keep them up to date with our market insights updates as well. So
yeah, Matt, I would add just one thing to that. You know, a thing that I would encourage everybody to do is consider blending different strategies that we have. Each strategy has a different sensitivity to these changing conditions. You know, we had 2 strategies, for example, in the last month that went from, you know, one went from 45% to 0, one went from 60% to 0, and then it went right back when that proved to be a false positive. We had other strategies that didn't adjust at all. You know, so by blending different strategies that have different sensitivities to change, you know, I think that would be a good way to kind of smooth things out, you know, over a full cycle.
Good point. Hence, our term actively manage risk that we wear on our sleeve proudly here as a differentiator. So listen, Gavin, thanks for your input on what happened.
Sure.
Rich, appreciate the intel on the Fed. And I know you guys will be traveling. And if I don't see you in person, I want to just wish you both a Merry Christmas, Happy Holidays, and hope you get a little time off to spend with your families as well. I know, Gavin, you'll be watching the markets every hour that it's open, but
I can't help myself.
Let's try to recharge the batteries before next market insights next month.
Sure.
Sounds good.
Thanks,
Happy
Matt.
holidays to everybody.
Okay. Bye-bye, guys.
Okay. Bye.